First of all, I want to say that it is awesome that you are thinking about investing. I'm not going to tell you exactly what stocks to invest in. I'm not a financial advisor and I'm not legally authorized to do so, but I will teach you how to select individual stocks for yourself. Insert something about a person and a fish and teaching a person how to fish. All right, let's get started. I'm Sean, here to help you build confidence in your financial and investment decisions. For most people, I'd argue that the best route to go is to invest in low-cost index funds. Personally, my favorite is VTSAX or VTI, which is a low-cost index fund and ETF respectively for the total US stock market index. I'd totally be comfortable and happy with 100% of my stock investments in this fund. Another one is the S&P 500, which is an index for the largest 500 US companies. The world-renowned Warren Buffett even stated that, in my view, for most people, the best thing to do is owning the S&P 500 index fund. Simple as that. But for those of you willing to take on extra risk, stress, and potentially more financial gain and loss, here's how to select and evaluate individual stocks. You should purchase individual stocks expecting to hold them for at least 1 year. You don't want to fall into the common mistake of buying a stock, having that stock value drop 5%, and then sell immediately at that loss. The best thing you can do for your investments is to create a plan and stick with it. Right before the 1 year mark, you can go back and evaluate the stock and determine whether you want to sell it or hold on to it longer. Individual stock investing carries incredible risk, especially compared to low-cost index funds and ETFs, which are broadly diversified index funds that track the market. What I preach and do so myself is to keep the majority of your investments in low-cost index funds. A couple of my favorite are here. Low-cost index funds and ETFs are great investments because you end up spreading out your risk by buying a basket of stocks. Now, these baskets can range from anywhere from hundreds to thousands of stocks within each fund. There's less volatility, and historically, investors that try to grow with the market instead of beating the market end up winning in the long run. They win on two fronts, financially and time-wise. They end up with higher investment portfolios and spend less time managing them. If you still choose to invest in individual stocks, keep it at a percentage that you'd be comfortable with losing. If you are fairly risk averse, stick to 5% of your portfolio in individual stocks. If you are far from retirement and are comfortable with volatility, then you can consider percentages like 20, 30, 40% or more of your portfolio in individual stocks. The best indicator of your investment risk tolerance is how you act in a downturn. If the stock market crashes 20, 30, 40%, do you sell your stocks for that loss? Do you panic and sell or stay true to your investment plan? If you feel mortified and sell, then that is a good indicator that you are not risk averse when it comes to investments. In that case, you probably shouldn't risk it with individual stocks because the value of individual stocks fluctuate much wilder than broad diversified funds. There are plenty of stories with people getting rich investing in certain stocks, but these are all survivorship bias. Those who make a ton of gain with their investments are more likely to share those decisions. But for all these success stories, there are just as many failure stories. Invest no more than what you're willing to lose in individual stocks and expect this portion of your portfolio to fluctuate wildly. 3 steps in choosing individual stocks. Decide what kind of stocks you're looking for. Then search for stocks that fit your criteria. Lastly, evaluate those stocks. There are thousands of stocks available on the stock market, and finding one or a couple that you'd actually like to invest in can be challenging. This is why we narrow down our search. Invest in what you know. If you're in a particular industry and know the latest trends and information within that industry, it may be a good place to start there. What industry would you like to invest in? There are plenty of industries out there, from consumer discretionary, energy, financials, healthcare, technology, utilities, and more. What size company do you prefer? Do you want to invest in large, mid, or small size company? Do you want to invest domestically in your country's companies or go internationally? Growth, dividend, or value stock? There are two ways investors can make money from the stock market. One is with capital appreciation, where you buy a stock and the value of that stock increases. You then technically gain money from that, or you can gain money through a dividend. When companies have earnings, they can decide whether to reinvest those earnings back into the company to grow the company, or they can choose to reward their investors by paying them out with a dividend. Basically, a dividend is the company's earnings passed on to you for your support in that company. Value stocks, on the other hand, are when investors believe a company is selling at a cheap price relative to the future potential of that stock. After you've determined what you're looking for, do a search. To invest in a particular industry, an easy way to find stocks is to look up a sector ETF, browse through the stocks in the fund, and then evaluate them. The first and most popular metric to evaluate individual stocks is through its PE ratio. This stands for price to earnings ratio. It's calculated with the share price of the company divided by the company's earning per share. The higher the PE ratio, the more expensive the stock is because the price of the stock is greater, usually, than the earnings. The lower the PE ratio, the cheaper the stock. You probably won't ever have to calculate this because it's provided in most investing platforms. The PE ratio gives you a quick glance in deciding whether a stock is relatively cheap or expensive. Generally speaking, stocks with a higher PE ratio than the broad market is considered expensive, and stocks with a lower PE ratio than the broad market is considered cheap. The average S&P 500 PE ratio is 34.24. You can use this as a benchmark when you quickly glance at stocks. But the industry of a company plays a huge role in its PE ratio. The financial sector and the energy sector will have PE ratios in different ranges, and investors are usually comfortable investing in different sectors when they fall within their particular PE ranges. Different sectors have different PE ratios, so when deciding whether a PE ratio of a stock is good, compare it to a similar company in the industry. Even with the PE ratio, it's not as simple as buying companies with the lowest PE ratio, aka the cheapest stock. If that were the case, we'd all be making so much money. There are some characteristics of a company that the PE ratio ignores. Debt. A company's financial situation isn't captured in a PE ratio. A company may take on millions of dollars of debt, but may perform an action such as a share buyback, where a company purchases its own shares, lowering the number of shares available to investors, increasing the earnings per share, and therefore lowering the PE ratio of the company. In this case, more debt used strategically lowered the PE ratio and made the company look more enticing to investors that only based their investments on the PE ratio. That's why we consider more than just the PE ratio when selecting individual stocks. Let's continue. You want to consider a company's competitive advantage within its industry. Does it have a patent or copyright for their innovative technologies that make it a step ahead of everyone else? Does it have brand recognition? I recently read that Apple is considering getting into the electric vehicle space. Now, Apple has never made anything like this, but the brand recognition of Apple makes it look enticing. Apple usually isn't the first one to get into a market, but when they do, they make a product that has high quality. Is there a barrier to exit for customers of this company? And one other thing is to consider whether the company has government permits that make it difficult for other companies to join their space. You also might want to consider a company's dividend yield. This goes back to whether you're an investor who looks for growth, value, or dividend stocks. I personally don't look at dividend yield at all because I always reinvest my dividends anyways, and having a dividend is essentially a forced sale. you end up paying taxes on those dividends. I personally plan to create a video where I compare growth stocks and dividend stocks with dividends reinvested, so be sure to subscribe so you get notified when that video comes. When selecting individual stocks, you also want to consider the future potential of that company. The value of the stock market is not reflected in the current economy, but rather more accurately is reflected by the expectations of investors. It's how investors feel about the future. When searching for companies, consider which companies are paving the way towards the future. Are certain companies working on innovative technologies that might revolutionize a certain industry? And are they a few years or several years away from making this breakthrough? Streaming services was considered novel at first, and people were hesitant. Online orders and shipping weren't a thing until a company made it convenient and cheap. Even sending money electronically was initially weird and untrusted until people realized it was extremely convenient. When looking at a company, consider whether that company is paving the way for a brighter tomorrow. These are companies that have a high growth potential and are worth keeping in your investments for several years. To recap, decide what kind of stocks you're looking for. Consider the industry, company size, domestic versus international, growth versus dividend versus value, and more. Search for stocks that fit your criteria. Search based on the preferences you listed in step 1. Evaluate the stocks. Consider factors such as the PE ratio compared to the S&P 500 or a similar company in the same industry. Consider its competitive advantage, dividend, and future potential. Be sure to subscribe for more information on personal finance and investing. Thank you all for watching. I'll see you all in the comment section below. Peace.